Okay, this is exercise 6-6. That's on page 284 in the Phillips-Libby text. So E66 deals with preparing a bank reconciliation and any necessary journal entries and reporting cash. So we're told that the September 30th, 2014 bank statement for Caddo Corp, or company, and the September ledger account for cash are summarized in the white boxes on that page. We're also told that no outstanding checks and no deposits in transit were noted in August. However, there are deposits in transit and checks outstanding at the end of September, so we'll need to take a note of those. We're also told the NSF check and electronic funds transfer involve transactions with Caddo Company's customers. And the first thing we're asked to do is prepare a bank reconciliation. So if we think about our reading from chapter 6, we know that our bank reconciliation should start with the balance per the books, which we're told was $26.50, and then the balance per the bank, which we're told was $230 at the end of September. So I'll just get these in comma format here to be a little easier to read. Remember, in our bank reconciliation, we don't reconcile one balance to the other. We reconcile them both to a new adjusted balance, and that's our go-forward cash balance. So we're looking for items that should be additions or subtractions to either side here. We're told in that descriptive that there are some deposits in transit and some checks outstanding at the end of September. So both of those items would be items that we would have recorded on the books already, but the bank would not have accounted for already. Right? So let's look for those first and deal with those. So in our deposits, we see that in the ledger account for cash, we've made deposits of $3,000 and $2,500, September 10th and September 30th. When we look at the bank statement, we see that the bank only has us making one deposit of $3,000 on September the 11th. So clearly the September 30th deposit for $25 is still in transit. The bank has not added that to our account yet. So on the balance per bank side, we want to add deposits in transit. And again, that was $2,500. We also want to deduct, and I'll leave some space here, outstanding checks in the amount of whatever we can find here. So if we look at our ledger account, we've got checks 101, 102, 103, and 104 recorded in our ledger account. And on the bank statement, 101, 102, 103 have all cleared in the checks column. So that means check number 104 has not cleared the bank yet. So we would deduct from the bank side here that $50 check 104, and I'll just note that out to the side here. We're also told that the NSF check and the electronic funds transfer noted on the bank statement involve transactions with our customers. So the bank in the other column on the bank statement noted an NSF check of $100 and an EFT deposit of $150. Now, those are items that the bank obviously has accounted for already, hence why they're on our statement, but we would not have accounted for those yet. The NSF check, we wouldn't have known that that's bounced, and the electronic funds transfer deposit was collected by the bank on our behalf directly from our customer. So over here on the book side, we want to add the EFT deposit or collection here in the amount of $150. And down here we want to deduct that NSF check, and that was $100. Now, one item we see on the bank statement on September the 30th is a service charge of $20. That's not something we have booked already in our ledger account, so we need to make that change to our books as well. So here we're also deducting a service charge in the amount of $20. Now we can come up with an adjusted balance here. So the adjusted balance on our book side is the $26.50 ending ledger balance plus that EFT deposit of $150 minus the NSF check of $100 and that $20 service charge. So an adjusted balance of $26.80. Over here on the bank side, we're looking for the same adjusted balance. That's the $230 bank statement ending balance plus the deposit in transit of $2,500 minus that outstanding check of $50, and there's $26.80. So those match, so we've accounted for everything. Again, that's our adjusted balance going forward. So the second part of 6.6 asks us to give any journal entries that should be made as a result of the bank reconciliation. Well, as we read in chapter 6 and thought about logically, the only items that need journal entries are those items that are adjustments to our book balance. So in this case, it's going to be the EFT deposit, the NSF check, and the service charge. So I'll just do a little ABC journal entries down here. We won't use the template for those. So for that EFT deposit, we're increasing our cash by $150, and we're told that's coming directly from our customers. So that's probably in payment on their account. So we'll go ahead and decrease accounts receivable and assume that that's what that collection is from. Okay, so collecting $150 on customer accounts. The NSF check is a payment received from a customer that is invalid, right? It's a bounce check. So we need to decrease our cash account by $100, and we hope to still collect that. So we'll actually increase our accounts receivable for $100, and we'll give that customer a call and see if we can't collect $100 from them. Finally, we have that service charge. We can call that just service charge expense, maybe operating expense, either one is fine. That was $20, and we need a credit to cash for that same $20. Now when I book these journal entries, that will bring my ledger balance to that $26.80, and that'll be my go forward balance. So number 3 asked us, what should the balance in the cash account be after recording the entries in requirement 2? Well, there's our answer. It should be that $26.80. Number 4 says, if the company also has $400 of cash on hand recorded in a separate account, what total amount of cash should the company report on the September 30 balance sheet? Well, that would be the $400 in this extra account, whatever that is, plus that $26.80 we've got in this cash account. And that covers the requirements for 6-6. Okay, this is exercise 6-11 and 6-12. 6-11 says the following transactions were selected from the records of Evergreen Company, and we've got several sales transactions there. Assuming that sales discounts are reported as contra revenue, we're to compute net sales for the 2 months ended August 31st. We'll actually do that second. 6-12 asks us to prepare journal entries to record those transactions, assuming that Evergreen uses a perpetual inventory system. So we'll do that part first. Remember, perpetual inventory system means we're keeping track of sort of a running total of inventory. We're not waiting until period end to make those calculations. So on July the 12th, I'll date these as well here, we sold merchandise to Wally Butler, who paid the $1,000 purchase with cash. The goods cost Evergreen $600. So our perpetual inventory system says we need 2 entries here, one to record the sale and one to update our inventory. So we collected cash, so we'll increase our cash account by $1,000. And we'll record sales revenue for that total. Okay, increase our revenues with credits. We'll finish out this entry here first. Our revenues have increased, so our net income will increase. On the balance sheet, our assets increase, our equity increases due to the increase in net income. And on the statement of cash flows, that's an operating inflow. Now we need to update our inventory for that transaction. We're told that the goods that we sold to Wally cost us $600. So we need to debit or increase cost of goods sold, which is an expense account, by that $600. And we need to credit our inventory account by that same amount. Okay, we need to show that our inventory level has decreased by the amount of the goods that have gone out of the building to Wally here. So our expenses increase, which means our net income decreases. Assets decrease, stockholders' equity decreases, and there's no cash effect. Here on July the 15th, we sold merchandise to Claudio's Chair Company at a selling price of $5,000 on terms 310 and 30. The goods cost us $3,500. So Claudio's Chair is not paying us anything in cash, right? They're buying on credit, terms 310 and 30. So we need to record the amount that they owe us. Accounts receivable, it's an asset, so we'll increase that with a debit in the amount of $5,000. We can go ahead and record sales revenue for that same $5,000. We've provided the goods to the customer, we just haven't been paid yet. Here are revenue increases, so our income increases. Assets increase, as does equity, and there's no cash. We also need to update our inventory. So those goods cost us $3,500, so we need to record cost of goods sold for $3,500, and then decrease our inventory by the same amount. Again, we need to show that we are $3,500 less on the inventory pile. So there's a credit to inventory. Here our expenses have increased, cost of goods sold, which means net income will decrease. Assets decrease, as does stockholders' equity, and still no cash involved. On July the 20th, we again sold merchandise, this time to Autos, at a selling price of $3,000, terms 310 and 30. The goods cost Evergreen $1,900. Very similar entry to our previous one. I want to record accounts receivable. Right, Autos owes me $3,000. I can recognize sales revenue for that same amount. I've provided goods in that amount to them. Revenue increases, income increases, assets increase, equity increases. I also need to update my inventory. So I'll record cost of goods sold, increase that account by the amount that the goods cost me, $1,900. And I want to decrease my inventory account by that same amount. Just want to make sure my inventory shows the current amount of goods available. Here my expenses increase, so my income decreases. Assets decrease, equity decrease. On July the 23rd, we collected payment from Claudio's from the July 15th sale. So here the timing is important. They are paying us 8 days after their original purchase. So they're within the 10-day discount period. So they get a 3% discount. Right? Remember, 310 and 30 means 3% discount if paid in 10 days. Balance due in 30. Okay, so Claudio's gets a 3% discount on their original purchase. So we did receive some cash, so we're increasing our cash account. We know they're getting a discount, so we know we're debiting our sales discounts, which is a contra revenue account, by some amount, the 3%. And we're eliminating their entire receivable. They're paying us in full. They're just paying us a little less than we initially gave them in goods. Okay, so they owed us from that sale on the 15th $5,000. So we're eliminating their liability for $5,000. They're getting a 3% discount. So we can say 3% times that $5,000 purchase means their discount is $150. And we're receiving in cash the difference between those two. right? So that's the $5,000, the original amount they owed, minus the discount we've granted them, or $4,850. Again, make sure your debits equal your credits, and that everything else is still in balance. So here, our revenue, be careful with this one, decreases because our contra revenue increased. If revenue decreased, net income decreases. My assets have gone both up and down, but they've decreased by a little bit more than they've increased. So we'll say a net decrease. And my equity has decreased due to that decrease in net income. So be careful there. Statement of cash flows, I did receive cash from regular sales. So that's an operating inflow. And I am all set. Okay, only one more to worry about here. August 25th, we collect payment from Otto's Ottomans from that July 20th sale. So they're paying more than a month in the future here, so they have missed out on their opportunity for a discount. So the only accounts I need are cash and then accounts receivable. Right? They are still paying in full, but they've missed their discount window. So I want to increase cash by their payment of $3,000 paid in full. And I want to decrease my accounts receivable by that same amount. Notice that nothing happens on the income statement when I do that. Okay, I don't have sales discounts involved, just have asset accounts. So no income statement effects. On the balance sheet, my assets increase and decrease by the same amount. And on my statement of cash flows, I'll record that as an operating inflow. Now, if we think back to technically what was 6/11 here, we wanted to come up with a net sales number for these 2 months. Well, net sales, if you recall, is gross sales less sales discounts, less any sales returns and allowances. So in gross sales, we had a total of how much? Well, we had 3 separate sales here. $1,000, $5,000, and $3,000. So that's a total of $9,000. We had sales discounts of $150, and we had no returns and allowances. So our net sales is simply the $9,000 gross sales number minus that $150 in sales discounts. Oops. Or $8,850. Thus ends 6/11 and 6/12.